Hello ladies and gentlemen, and a warm welcome to today's webinar brought to you by sharedserviceslink.com and 3C Insights. KPIs are a major theme for shared services organizations, especially the more mature shared services that are very much in the continuous improvement phase. These shared services organizations rely on KPIs to drive improvements, and the key word in that sentence is the word rely. And the reliance on KPIs means that KPIs need to be managed in a thoughtful, planned, intelligent manner that very much link in with the intended outcomes and drive the behavior that serves the shared services organization and indeed the company. So I'm very pleased to say that this webinar is looking specifically at how complex shared services are managing and using KPIs as a tool. And we'll be drilling down into the good practices and the bad practices, and specifically the 5 steps to make a difference. So let's have a look at the presenter lineup for today. My name is Susie West, and I'm the founder and CEO at sharedserviceslink.com. And I'm very pleased to be presenting as my guest speakers Grant Fitzwilliam, who's the Managing Director at 3C Insight, and Kelly Notto, who's the Director of Operations at 3C Insight. So just before I hand over to our guest presenters, let me just give you a little bit of background on this webinar and how it came about. So in February 2013, 3C Insight and sharedserviceslink.com wanted to look at how shared services organizations were indeed managing their KPIs. But not only that, 3C Insight was very keen to find out to what degree shared services organizations were offering the KPI management as a service to their customers. So actually extending it out as an actual service to their internal business units, their customers. And I'm very pleased that we had a study that looked into these subject areas, and we're going to be walking you through the really fascinating findings that came out of that study. And the outcome of that study is a report which you will all be sent after this webinar. So we'll be going through the key findings in the next minutes. And just before we do that, I would like to start off with our first poll question, which is on the screen now. So let's find out what your goals are for your KPI management today. You may have a number of boxes to tick here, so please tick all that apply. Are they consolidating definitions, investigating global consistency, automating reports from systems or applications, assigning accountability and resourcing, or perhaps your goal regarding KPIs is to eliminate the use of Excel? So if you can have a look at that and tick the appropriate box, please. I'll be closing the poll in 3, 2, 1. Let's have a look at the results coming up on the screen now. So we're at 68% of you responding. So you can see here that the majority of you ticked the box assigning accountability and resourcing. And interestingly, only 32% of you said that one of your goals was eliminating Excel. So an interesting set of results there. And with that, I'd like to hand over to our first guest speaker, over to Grant Fitzwilliam from 3C Insight. Over to you, please, Grant.
Thank you, Susie. Before we go into the details of the survey, I'd like to point out 2 headline statistics. First is that 77% of complex shared services still use Microsoft Excel as their only or primary method of capturing, calculating, and communicating KPIs. Think about this statistic in light of the profile of the survey respondents that we will be sharing shortly. We know Excel has positives, but what about version control, spreadsheet errors, its non-collaborative nature, and all of the manual intensive processes surrounding its use? The second key statistic we'd like to share is that 41% of respondents said they were not offering KPI collection and management services to their end customers. What this suggests to us is a lot of opportunity for large complex shared service organizations. Let's start with what a definition of KPI management is and is not. First, we'll start with what it's not. It's not just tracking a series of metrics and providing dashboards. That's part of it. What it is is an act of deciding what to measure, how to repeatedly measure, how to provide visibility, impact the results, track improvement plans, refine scope, and changing priorities. We find that very few people actually sit down and define KPI management holistically. You should think about what your key goals, both short and long-term objectives are, and start to measure and align those measures with these associated goals and objectives. You should be including targets, drill-down analytics, and coming up with a consistent cadence of presenting these metrics to not only your internal group, but your customers as well. Let's take a look at the profile of the survey respondents. First, we find that they are large. 61% have annual revenue over $3 billion, and 1 in 5 have revenue greater than $20 billion. We have good global coverage from the respondents, and we find that 76% are servicing more than one country, and over 1/3 are supporting more than 20 countries. Translation, lots of complexity. Susie, over to you for polling question number 2.
Thank you very much indeed, Grant. So before we have a look at the average age of the respondents that participated in the survey, let's find out how long your shared services organisation has been running. So is it less than 1 year, or tick that box if the question is not applicable to you? Is it 1 to 2 years, 3 to 5 years, 6 to 10 years, or more than 10 years? So we like to get these response rates up past the 70% mark. So we're currently at 66%. So if you haven't already responded, please do so. We've got 5 polls throughout the course of the webinar, and this is poll number 2. So closing the poll in 3, 2, 1. Okay, thank you. We were at 75% of you responding. So let's have a look at the results. Okay, so interesting results there with the highest number, 28%, in the 3 to 5 year bracket. And we've got just shy of a quarter of you with running a shared services organisation that is more than 10 years old. So I think it's fair to say that we have a set of mature organisations on the webinar today. Interesting results. Back to you, please, Grant.
Thank you, Susie. Pretty close to what we saw in the survey, a little bit higher in the over 10-year bucket. We had 31% that had been running shared services for more than 10 years, so some fairly mature organizations participating. So we'll see how that is significant when we look at the results a little bit later. A couple of other profile points. Complexity continued. 44% are supporting more than 5 business lines, 67% supporting more than 5 business processes. And over to the right, the predominant business model is a regional shared services organization, which makes a lot of sense given that a lot of you are supporting more than one country, and we've got over 1/3 supporting more than 20 countries. Let's review the ERP landscape of some of the survey respondents, which is something near and dear to my heart. We've got 59% who are operating on 2 to 5 ERP instances. We have, in fact, 1 in 4 that have over 12 ERP instances and not always running the same ERP across the board, which means dealing with multiple data sets, lots of IT partners, and multiple ERP terminologies. Interestingly, we've dealt with a couple of very large companies as of late. Both were actually running the same number of ERPs, 25 in total each. And if you think about the size of the challenges this creates from an IT collaboration perspective, defining metrics, and then trying to use, I'll call it manual-based tools like Excel to try and collaborate on the KPI management perspective, it really does pose a significant challenge for organizations with that kind of complexity. Now that you've got an idea and flavor of who's responded to the survey, let's see how they are measuring performance internally. The sweet spot in terms of number of key measures per process area is between 5 and 15 per process area. That's 56% of the respondents. The second biggest bucket was the less than 5 metrics per process area, where we have 34% of the respondents, and then a small group, 10% in total, that have more than 16 metrics that they are capturing per process area. Keep these colors in mind as we're going to use them on the next slide. Remember that the orange is the 5 to 15 metric group, and the green is the less than 5 group. This slide depicts how respondents want to enhance their measures going forward. A little bit of a complicated slide, so let me walk you through it. On the left-hand side, we have those white rectangles that are the different buckets and the different priorities that people have going forward. We've got increasing the measures being tracked, keeping the measures stable but altering what measures are tracked, and then we've got same number of metrics with differentiation between critical and other measures, and then finally reducing the number of measures being tracked. If we look at the green group, which is the less than 5 measures per process area group, we see that a fair amount of them are looking to increase their measures and to a lesser extent alter their measures. If we look at the orange group, which is the 5 to 15 KPIs per process area, we see that there's a lot of work going to be done in terms of altering existing measures and defining the critical ones, as well as potentially increasing. We see a large group there looking to increase those metrics. If you look at it in total, we see that 36% in total of all respondents are looking to maintain the number of measures they have but differentiate critical from other measures. Surprisingly, we found that 10% of respondents have no formal KPI management program at all, and another 37% are what I call doing the basics, which is simply accumulating and publishing measures rather than doing all of the value add around it. Again, an illustration that this is an opportunity to demonstrate additional value in many of the shared service centers. This slide shows the 37% group that we just mentioned that are doing the basics. That's that green part of the ring. The remainder are distributed across increasing levels of KPI management maturity for, again, shared service business processes internally. If we look at the most mature of the groups, we can look at the 10% group on the left-hand side, the orange 21% and the red 11% who are looking to compare and assign their KPIs to objectives and goals and tie them to performance plans. Now, there is risk of not aligning KPIs to goals and objectives. It's not just a nice to have. A couple of examples that we've run into are a client who was focused on reducing the number of late payments to customers, which had become a problem. And because they weren't looking at the KPIs holistically, they thought they were doing a good job because the number of late payments was coming down. Unfortunately, there was a corresponding increase in the number of early payments. And this was being hidden in the days payable outstanding calculation because the days payable outstanding calculation was overly distorted by intercompany payments. But needless to say, the working capital impact of this early payment problem that hadn't been detected was a $50 million reduction in working capital. A second example was a company focused on automation improvements, and particularly on the payment side in accounts payable, and were increasing their payment rate globally and were over 90% and pretty pleased with the result. But when you looked a little bit further into the details, what we found was that a large portion of those automated payments were being made via wire transfers. And so the cost per transaction had gone up as opposed to going down because of this expensive method of performing electronic payments. So again, something that we think you should look at in terms of holistic approach to make sure that you're tying all of your KPIs to objectives and not missing your blind spots. Let's now look at to what extent shared services are providing KPI management as a service to their customers. The first two items that jump out are that 41% of respondents do not offer KPI management services to their customers at all. And second, 39% do the basics of just providing the data without assisting their customers with improvement efforts. There is certainly a value opportunity on the table here. From a maturity standpoint, if you look at this chart, the first three bars on the left-hand side highlight respondents with lots of work to do in this area and lots of upside potential. They're either not providing any service in this area, are thinking about providing a service to their customers, or are just doing the basics. And then we have the four bars on the right-hand side where there's the companies that are definitely moving up the maturity curve in terms of offering the value-added services to their customers. Let me walk you through an example of how you can look at this in a practical sense in a three-step approach. If you think about step one and you're providing your shared service processes and KPIs related to those, that might be procure to pay as an example, and you're providing those KPIs to your customers, that would be step one. Step two, and increasing the value, would be looking at something like variable billing and how you charge your customers for transactions. If you separated the charges out by manual versus automated transactions, let's say, and you charged a higher rate for a manual transaction versus an automated transaction, that will help drive the process for improving the automation rate, and you can collaboratively work with your customer to improve that, and now everybody's got skin in the game because of the different charging rates. Taking it another level up the chain, if you think about KPI management even broader and across the corporation, if your shared services group has developed this internal skill of KPI management, you can look at supporting business processes that are not within the four walls of the shared services organization. An example may be pricing analytics, strategic sourcing, and sales analytics. Because of the shared services organization's knowledge of ERPs, the data structures, having the tools to provide KPI management services, you will be able to extend your offerings and provide these services out to these organizations, and these are much more value-added opportunities as opposed to just transactional-oriented processing. The key takeaway here is that shared service organizations are failing to take advantage of the value-added opportunities by leveraging their own extensive experience and expertise of KPI management. So what's holding everybody back? Not everybody, but most back. There are actually a multitude of issues that organizations are wrestling with, and it's not just one. If we go around the circle here, starting with the ERPs, obviously we talked about how lots of companies are dealing with multiple ERP systems. That's an issue. We've got a lack of functional and technical expertise, combined with lack of tools to accumulate, calculate, and display measures, as well as inconsistent definition of performance measures and overall inaccessibility of data. My suggestion to overcoming some of these challenges is to get executive sponsorship and involvement. And in order to do that, you're going to have to demonstrate what the opportunity cost is in terms of breaking down some of these barriers. And I typically go with the 3X model to explain and to quantify the opportunity to executives. And what I mean by that is explaining how the value can be provided in terms of 3X. As an example, we typically see that companies that are high performers have cost per transaction rates that are 3 times lower than the average company. Automation rates at high performers are 3 times higher than average companies, and exception transaction rates are 3 times lower. So that helps executives understand and quantify the value that can be achieved, and hopefully you can get their help then to break down some of these barriers. Now let's go back to that first statistic we talked about right at the beginning, which is the 77% using Excel as either the primary or only tool for measuring KPIs. Now we've just gone through some of the respondents' profiles in terms of lots of countries to support, which means multiple currencies, multiple time zones, lots of business units, the need to do trend analysis, comparing targets versus actual, having drill down capability into KPIs, possibly decentralized data entry and upload, and then the ability to benchmark to the outside world. I can only assume that there's a lot of elbow grease, pain, and frustration out there in terms of using Excel to deal with this complex environment that a lot of you are working through. So let's move on and talk about what are the top performers and how are they doing things differently. Let's first define what a top performer is. We define top performers as those organizations taking advantage of the value-added opportunity that KPI management as a service can provide to their internal customers, and are making intelligent use of their data. Here's a reminder of what that means. It means prioritizing measures, providing improvement plans, and tying performance gain to those improvement plans. Interestingly, we found that the top performers were not distinctive in terms of age, revenue, volume, or the way they which aligned to the business. However, we did notice that 100% of them had internal performance management programs of a similar maturity to that which they were offering to their customers. And a significant number used more sophisticated tools other than or in addition to Excel. I'm sure those top performers are continually looking at ways to reduce the role that Excel plays in KPI management, given their complex environments, though. Also, we found that 41% of the top performers, they're linking, and that's the key word, link their measures to performance plans. They're tracking more than 5 measures per process area. Another way of looking at this is that less than 5 metrics per process area is just not enough to provide the detail needed. In other words, Those who directly tie each KPI to business objectives have more metrics so that they can gain a deeper insight into what's working well and what's not. And if you remember those two examples that I talked about earlier on the payment automation and the late payments, clearly they hadn't linked their metrics to business objectives and were blindsided by the fact that they were creating corresponding issues by improving one particular area and not looking at it holistically. Okay, at this point I'd like to turn it over to my colleague Kelly.
Thank you, Grant. So at this point we've set the stage. We've talked about what KPI management means. We understand that the mature shared services organizations are tracking between 5 and 15 measures per process area, but 50% of those want to change the measures they track or better classify their measures. We also know that only 20% of the shared services organizations are leveraging their expertise with the global complexity and the ERP complexity to offer KPI management as a service to their customers. 10% of organizations haven't begun the journey to understand what a KPI management framework is, while others are at various points along that journey. So we would like to provide you with 5 practical steps that you can take to begin the journey to a holistic KPI management solution. Before we begin talking about our 5 practical steps, we'd like to understand a little bit more about your environment. So we're going to go back to Susie for a polling question.
Thank you very much indeed, Kelly. So coming up on your screen now, a polling question regarding the framework that you use for your KPIs. To what degree do you have a consistent framework across your business processes and business lines for managing KPIs? Would you say it's not consistent? It's a somewhat consistent framework, it's a mostly consistent framework, or it's a completely consistent framework that you use across your business processes and your business lines for managing KPIs? 50% of you have voted. If you haven't already responded, please do so. We'd like to get it up past 70%, please. Closing the poll in 3, 2, 1. We are at 71% of you, 72% of you responding. Coming up on your screen now, so interesting results with only 5% of you saying that there's a completely consistent framework across business processes and lines of business. And the highest number there you can see coming in at 43% of you saying you have a somewhat consistent framework. So interesting results. Back to you, please, Kelly.
Thank you very much. They are interesting and will hopefully help those of you that need to create a more consistent framework as we review the 5 practical steps. So as we begin that journey, we'll start naturally with step number 1, creating the framework. So as we think about creating an overall framework, we will typically ask our clients to answer or at least think about the following questions. Have they identified an approach that allows them to define their business objectives and link their measures to those business objectives? And have they identified the processes, the tools, and the people who will operationalize that framework? As we refer back to the initial polling question that we asked, 70% of people were interested in investing in assigning that accountability and resourcing to their operational KPI framework. As Grant discussed, tying measures to business objectives is what is required. Measurement for the sake of measurement is no good. So as we begin this journey, we need to create the consistent framework and the consistent lens through which KPIs can be delivered. When we work with clients to go through this process, we begin by talking about the attributes that need to be included in such a framework. For example, whose perspective does the measurement reflect? What's the frequency of the measurement? Who's the audience of the measurement? At 3C Insight, we like to think of our audience and our overall framework as a pyramid, with each layer building upon the other. At the top layer, we have the executive focus, those focused on outcomes. Here's where you would expect to see typical benchmark measures, such as cost per transaction. It's also where you begin to start to see some of your internal shared services organization measurements, such as survey questions around, was my customer able to achieve his or her objective when interacting with the shared services organization? In the middle layer, you have your management or director level measures. These are focused on the actions. This is where you would see measures such as journal entry automation rates. And at the bottom layer, you have your team and operational level measurements. These are focused on the individual tasks that allow you to accomplish your actions and your outcomes. here's where you'd look at what are the manual journal entries that are being entered. What's the number of them? Who entered them? When did they enter them? It's imperative that your employees at the lower levels of the pyramid have insight and visibility into the measures up the chain of command. They need to understand how the task level measure that they're being held accountable for fits into the overall actions and fits into the overall outcomes that the company is looking for. So once you have that framework established and you understand where you are, you can move into step number 2, which is providing consistent definitions. 44% of you were looking at consolidating definitions, according to the survey we did at the beginning of this webinar. The measures that fall into KPI frameworks do need consistent definition. If we think about what that means, it's no small task. 76% of the shared services organizations in our study supported more than one country. 33% had more than 20 countries. All of them have multiple ERP packages involved. So what does building that consistent definition involve? It starts with your stakeholders. It starts with who they are. It starts with your internal stakeholders, your business lines, your business process owners, your geographic regions. Each of them will have nuances that you need to go through and negotiate and reconcile. It starts with your software capabilities. There are differences in the software packages between Oracle, between SAP, between JD Edwards, how they allow you to enable measures or not enable measures that you may want to have. It starts with your external benchmarks. This is where benchmarking can often fall down. Managers at the lower levels do not necessarily believe the outcomes that were presented to the executives because the managers don't necessarily agree with the definition the benchmarking company used, or because they don't trust that all of the benchmarking data was captured using how they interpreted the definition. 2 examples of this include things like your journal entry upload. If you use a Microsoft Excel template to upload a journal entry, is that an automated or a manual journal entry? That can drastically impact how you result on your benchmark. Additionally, your AP invoice volume. For example, do you include expense reports in your AP invoice volume, or do you exclude them? Including expense reports can drastically change some of your denominators as you go through your process and evaluate your outcome measurements. At this point, you also need to go beyond your typical definition of a business measure. Make sure that every metric that you have actually has a business question that it's answering. As 3C Insight built our Oracle and our SAP connectors, we often found ourselves asking, wouldn't it be neat if we could take this numerator and this denominator and generate a new metric? And it was great. It was really neat. We could define the metric because our definition defined what the numerator was and what the denominator was. Everything was wonderful. And then we got to the step of asking, what does this answer? What does this measure tell me? We couldn't find an answer. So if a measure doesn't provide business value, if it doesn't answer a question, it's not worth developing. It's not worth either building a report for or coding. So once you go through an effort of defining your framework in step 1 and creating your consistent definitions and negotiating and reconciling across all of your stakeholders, you can then move on to step number 3, which is collecting and monitoring your performance. This is where the rubber hits the road. This is where execution is key. Execution is very key if employees understand that the KPI framework and the measures that are included in it are actually tied to their job descriptions and to their annual performance reviews. For the 70% of you that are looking at assigning accountability and resourcing, this is how you assign your accountability. You tie it to job descriptions and annual processing reviews. It is also imperative that the employees who are responsible for understanding and producing the measures are actually held accountable for on-time delivery of the KPIs themselves. It needs to be a part of their job, not an extra they do because they actually enjoy finding the data, but actual part of their job. So once they understand what the on-time delivery means, they move to capturing their baseline measures, calculating additional measures, setting targets and service level agreements, publishing their measures. When you're capturing baseline measures, this falls into 2 types of baseline measures. Those that are external to your systems, such as FTEs and costs. As anyone who's gone through a benchmark understands, These can be very difficult to capture, particularly the first time you're doing it. Once the initial baselines are captured, we at 3C Insight recommend that you're using your annual budget cycles to update those values. Or if you go through a major reorganization, you need to update those values. In addition to capturing your baseline measures external to your systems, you need to capture the baseline measures that are within your core operational systems, within your ERPs. These are things like your number of manual invoices and your number of electronic invoices. Once you pull the number of manual invoices, you also need to make sure that you understand the drill down. Who are your vendors that have the most manual invoices in any given month? We had one client where FedEx and DHL were submitting hundreds of manual invoices on a month-over-month basis. The client was able to dramatically reduce their number of manual invoices by simply working with FedEx and DHL. Rather than pulling an automated percentage, the client actually used the number of manual invoices and the number of electronic invoices to derive their invoice automation rates. It's simply a function of the two other values. You also then need to summarize up your organizational hierarchies, whether that is through an ERP business line reporting or through a country line geographic reporting area. How do you pull the data back together and slice and dice it? And when you are slicing and dicing it, you need to make sure that you're summarizing up your numerators and denominators and then deriving things like your automation rates, because your automation rate at a summary level needs to be a weighted average of all of the organizations underneath it. You can also calculate your quarterly and annual results based on your monthly results. When you have that available to you, you can set your targets and your SLAs. Your targets are typically your internal to your shared service center goals and objectives. Your SLAs are obviously service level agreements, what you commit to your external customers. You need to calculate your variances and understand where they are. We use an example quite frequently when we're talking to clients that variances may be acceptable with fixed asset adjustments, where you get 10 or 15 fixed asset adjustments a month, but you may have a particular month where you spike into the 20,000 fixed asset adjustments. You can do that for a variety of reasons. Perhaps you conducted a fixed asset inventory. It's not frequently done, but every now and then a company will go through and do that. Or you've been bought out by private equity and you had to go through your gap analysis of redetermining your fixed asset values. As long as you can explain your variance, a variance is okay. And finally, you need to publish your measures. You need to be consistent. Who, what, when, where. We actually have one client that's begun putting a couple of the outcome-based measures and a couple of the action-based measures on a bulletin board. The client is using the bulletin board to track and show their employees the measures. They actually have their customers who start to stop by on a routine basis looking at what the measures are telling them now, and they've begun to improve those measures. So once you kind of complete your step one of defining your framework, and step two, creating those consistent definitions, and step three, collecting and monitoring performance, we get to move on to step four. How did that client improve? This is where you begin to manage your improvement plans. And the question becomes, how do you do that? So to review some improvement methodologies of those on the phone, I'll turn it back over to Susie for our fourth polling question.
Thank you very much indeed, Kelly. So coming up on your screen now, what improvement methodology do you use? Please tick all that apply. Six Sigma, total quality management, lean, or perhaps some other methodology or some homegrown methodology, or perhaps you have no defined methodology. Please tick all that apply. What improvement methodology do you use today? Six Sigma, total quality management, lean, another approach or homegrown methodology, or perhaps you have no defined methodology. We're at 69% if you haven't already responded. Please do so, closing the poll in 3, 2, 1. Thank you. We are at 75% of responses there. So coming up on your screen now. So a third of responses don't have defined methodology. And we can see there that out of the responses that do have defined methodology, the most popular is 40% coming in at lean, so lean at 40% there. And the least popular you can see as far as the methodology is concerned is total quality management coming in at 9%. So interesting results. Back to you, please, Kelly.
Thank you very much, Susie. I appreciate that. The results are very interesting. Picking an improvement methodology is like picking the flavor of the month. The results show that total quality management was the flavor of the month a while ago, and now it's moving into the Six Sigma area and the Lean area. This slide will show you two of the flavors of the Six Sigma implementation, the DMAIC and the DMEDI processes that can be followed. It also shows you the 3C Insight homegrown methodology. So we assess and prioritize, execute, and operate. I must admit that I'm partial to our methodology because it includes the operate component. As the director of operations, that becomes very important to me. I don't want to do a project and spend my money and my resources and have an end date and everybody thinks everything's good. When I get the changes put in place, I need to make sure they become ingrained and they're monitored and they're operationalized. So as we then think through how do we use a methodology, it's just important to pick one and be consistent. Train your people in that methodology, whichever one you pick. All of the methodologies start with some version of a question or a hypothesis as to the theory of what's happening. When you're putting in your improvement plans, you need to look across the organization. You need to make sure that improvement in one area does not cause unexpected improvement in another. Grant's example of improving the automation rate by increasing the number of wire payments is instructive. I can see his wire payment increase and rate him one better. I actually had a different client that followed a similar path to increasing automation rates. In the end, they wound up paying one vendor over 500 wire payments in a calendar year. Yes, that's right, their automation rates went way up. They paid one vendor more than one wire payment per year. So where were they in the framework? If I think about it, their outcomes, their cost per transaction increased. Their actions, the thing that the manager was looking at, improved. The percentage of electronic payments went up dramatically. The task levels, those that should have been charged with looking at how frequently each vendor was being paid, what method was being used to pay different vendors. The task level measures were not being looked at all. So how do we now begin to make the adjustment to looking at what can we do? And before we start talking about the tools, we would like to go back to Susie for our fifth and final polling question.
Thank you very much, Kelly. So coming up on your screen now, what reporting tools do you use today? And please select all that apply. Desktop productivity, for example, Microsoft Excel and/or Access, ERP reports, business intelligence tools, a SaaS-based tool or third-party, or perhaps there is another reporting tool that you use. So please do tick all that apply. 62% of you have currently responded. Let's see if we can get that north of 70. What reporting tools do you use today? Closing the poll in 3, 2, 1. Let's have a look at the results. We were at 73% of you responding. So you can see that 92% of you, interestingly, 92% of you using desktop productivity tools, for example, Microsoft Excel and/or Access. So interesting results, and a higher number really than the number that we've been talking about here today. And you can see coming in second place there, 57%, so that's quite a drop down, 57% are using ERP reports. Interesting results. Back to you, please, Kelly.
Thank you very much, Susie. So we've completed step 1. We've defined our framework, and we've completed step 2. We've got our consistent definitions. Step 3 involves collecting and monitoring performance, and step 4 was the managing of improvement plans. So now we move on to step number 5. How do we create scalable alternatives? As Grant talked about, the use of Excel is complex because we're in large, global, complex organizations. Interestingly, the poll number 1, only 32% of you were concentrating on eliminating Excel. So the 92% of you that are actually using Excel, of that only 30% of you were looking at eliminating some of that use of Excel. So this begs 2 questions for us. One is, how do you use it effectively? And hopefully we'll give you some practical advice in how to potentially use Excel more effectively. And then second, what scalable alternatives are in fact out there. So when you're using Excel, use it effectively. Capture your data in a repository format, not a presentation format. This will allow you to use things like pivot tables and pivot charts to access the data and enable your trend analysis and your filtering of results. It still doesn't impact your things like your currency conversions, etc. To create scalable alternatives, you need to work to build simple reports within the ERPs that can be used for trending, etc. As you build those reports with one of your IT organizations, you need to make sure that you can leverage that report across all of your ERP instances. You need to make sure that your SAP and your Oracle or your SAP and your JD Edwards can pull things together and consistent. You need to look beyond the solutions that are offered by the standard software vendors such as OBIEE and SAP's BW to products such as ClickView that are a little bit smaller to implement, not quite as heavy on the IT budget. Then you also need to investigate your SaaS offerings. And finally, we'll return again to the 70% of you that are looking to assign accountability and resourcing to your shared services. As you look through those people, make sure that you're understanding your human resources within your shared service center. Recognize the people that are helping perform and pull your KPIs. Let them know that that is a crucial part of their job and a crucial part of the shared service center organization, not some bolt-on that somebody has to go do on a periodic basis to make a manager happy. Send them to training. You know, there are classes available in Advanced Excel that may help those of you that are experiencing a lot of elbow grease. There are classes available on BW and OBIEE. Make sure that you're sending the employees that have shown an aptitude for this type of work to the appropriate classes so they can make full use of the IT investments you've made, whether that investment is your Office license on your PC or millions of dollars in your business intelligence solution. So as we wrap up, just to remind you of the 5 practical steps that we move into a shared services journey. You need to create your framework. You need to create consistent definitions across the globe. You need to collect and monitor performance. You need to manage your improvement plans and create scalable alternatives. Each of these 5 steps are efforts in their own right. So hopefully on this slide you'll see the 5 tactical steps that you can take as you hang up the phone today to understand what you can do to begin this journey. Sit with your team, discuss your shared service center's approach to a holistic KPI management program. Don't just focus on the outcome measures, but focus on all of the measures you need down the food chain to affect the outcome. Conduct a current state assessment of those metrics. Make sure you understand what each team is doing. You'll find some teams are doing things similar. You'll find some teams aren't doing these types of measurements at all as you move down that food chain. Understand the source of each of your measures. If one of your employees wins the lottery, can you produce that measure next month? Embed the measures in your human resources processes. Tie the KPIs to job titles and annual performance reviews. Some KPIs can be at the team level as long as they understand what the team level is. Some KPIs need to be at an individual level that they can control by themselves. Evaluate your various Excel spreadsheets. Look to see if you can make formatting spreadsheets that will help you with trend analysis or organizational hierarchy analysis. And then finally, as we talked about, make sure that you're training the skills in your entire organization. So with that, hopefully that gives you both 5 practical steps to do and some 5 practical steps to do as soon as you finish with questions and answers. So I'll turn it back over to Susie for the question.
Kelly and Grant, thank you very much indeed. We have just shy of 10 minutes for questions. So let's start in the order that they've been coming through, and if you haven't posted your question, please do so. How do you set the KPIs for various shared services organization stakeholders? And the question here is, what are the dimensions? What kind of tools help a shared services center to measure their KPIs? So really 2 questions there. How do you set the KPIs according to the various stakeholders, which we did touch on, Grant touched on earlier. And Kelly, you talked about the tools, but what kind of tools help shared services organizations measure?
This is Grant. As far as the first question goes, to focus on knowing what your stakeholders' business objectives are, whether it's improve working capital, it's increase the transaction volume within shared services, whether it's reducing cost per transaction. Those will help drive what your KPIs need to be, and as Kelly walked you through that pyramid, you need to start at the top of the pyramid and work your way down and then define KPIs that are at the top level, and then the ones that support those, and then the ones that will support those from a day-to-day tactical level. In terms of what tools, there's IT obviously within your organization to help pull data, and you can pull the data from your systems and try to use it consistently if you have multiple versions of an ERP so that you can use the same report in multiple environments. But you're looking to pull things like transaction volumes by type, and you're looking to pull cycle times, etc., and then combine those with the manual data points that Kelly talked about, such as dollars, the cost, as well as FTEs, and then you can combine those three pieces of information to create ratios and percentages. But the more you can automate the gathering of metrics, the more you will have consistent metrics and eliminate some of the manual massaging or inadvertent definition differences that can apply if you're manually gathering those metrics. Kelly, anything you want to add to that?
I would just say that the effort of getting the consistent definitions and understanding what attributes you need to capture as an organization is also of value. So it's going through what those definitions are and understanding all of the different attributes and approaches to those definitions. And at the end of the day, a certain amount of it is making sure that those stakeholders that we've talked about, whether it's your business lines or your business process owners or your geographic regions, are in some ways in the same room talking amongst themselves. So one of the jobs of implementing, or one of the benefits of implementing this framework, is to actually break down some of the barriers that can be artificially put up within an organization.
Okay, thank you very much. So what if the performance measures defined are influenced by a third party outside the team? How do you deal with that situation?
I can think of an example in terms of procure to pay. And let's just say that the payables function is within shared services, but the purchasing function is not. A lot of manual effort will occur in the payables function if purchasing is not using purchase orders very often, or they're incomplete, creating matching errors, etc. So that would be an example of where shared services is influenced by an upstream process that is out of their control. And I think this goes back to, this is where you need to go and get executive level involvement to go up the food chain so that you can get somebody involved who is above both purchasing and payables, and you can explain the issue, get them to help collaborate with purchasing, set measures that measure purchase to pay as a whole, and again use maybe that 3X model where you can show that the benefit and outcome of doing this is that I can reduce my transaction costs within payables if I can get purchasing to do a better job, and putting that in terms of dollars and cents values in front of the executive to get them to help you get the involvement of the purchasing department to solve the problem that's occurring in payables.
This is Kelly. I'm just going to add one quick thing to that, and that is sometimes it's of benefit simply to be showing to the purchasing department the amount of pain that they're causing. So if you have a good measure of where you had an issue and you start publishing on a monthly or a biweekly basis how many invoices are now coming in with a purchase order matching problem, you can be talking through with your purchasing department and saying, we're holding you accountable for these. You may get into some variable billing components that Grant had talked about as well earlier in the webcast. But sometimes it's just enough to actually share those measures and those metrics with the upstream process owners. I have an example, not within a shared service center, but within a call center, of a manager who was monitoring some of their call statistics around average length of call, etc., but was not monitoring their abandonment rate. And so when we ran her a report that talked about your abandonment rate is 28%, of customers who just get so frustrated they hang up the phone and you never even get to talk to them. As soon as we showed her that and she brought that to her team, within 2 weeks her abandonment rate had dropped to 5%. So sometimes it's just enough to share the measure. Mm-hmm. It doesn't always work, but it can.
Okay, good. Thank you. So I think we've just got time for one more question, which is around the collection of data. So what do you do if the collection of data for the measures is time-consuming and it's complex, i.e. there's no available data at hand and might just have to be collected in a manual way? How can you encourage people to put the effort in to go and do this?
This is Kelly. I'm going to offer an example of that where I was working with a client who was trying to prove to their IT department that they had an actual application response time performance issue. So we went out and actually gave the people on the floor, the people within the service center, stopwatches and had them literally time and track manually what times transactions took. And we had them do that over a 4-month period at periodic basis. And we kept bringing those results back to the IT organization. And at the end of it, we could show that we had achieved a 90% improvement in particular transaction types, simply because we had the volume. Now, was it a manual effort? Yes. Was it painful? Yes. But at the end of the day, the thing that we did was make sure that we did simple things. We wrote handwritten thank you notes to the people that had taken the time to help us prove out our performance issue. We walked the floor while they were doing it and said, thank you. We know it's painful to do this, but we also know that it's important. And getting back to the visibility point that we made on the framework itself, we made sure that the people at the lower level of the organization actually saw the results. We didn't just share the results with our executive team and claim credit. We actually, took the worker bees and showed them what they had done and what they had accomplished and said thank you. So they're just a couple of quick sort of tactical ways of doing that. You can't always get around time-consuming collection processes.
One final quick thing to add is that you want to start small if there's difficulty in collecting data. So pick the handful of things that you think you can get a lot of value from those metrics and that they're high impact. So start small and don't start with too big of a bucket of metrics that you're trying to accumulate if it's very difficult.
Ladies and gentlemen, you've probably seen and heard that this has been a very useful webinar indeed. We will be sharing the report with you next week as a thank you for dialing into this webinar. And a huge thanks to all the work and input provided by Grant and Kelly for this webinar. Thank you very much and goodbye.